guess one of the most common mistakes that I see that property investors make is that they don't all seek advice from the professional, and by that I mean the accountant or the finance broker. The perception is that because they have set up a mortgage or have a home loan in place that it's all easy now going forward, but it's not. I think it gets a little bit more complicated as you go forward and really seriously start investing. So it is paramount that and a property investor speaks to their accountant about strategy and structure, and to their finance broker who actually follows the instructions of the accountant in setting up the loans correctly. Structuring the loan is correctly from the outset it's paramount. So many times I've seen the actual structure is set up incorrectly, which then has costly repercussions, particularly when, in examples where the home loan has been topped up, as opposed to setting up a separate equity loan for the purpose of investing. As an investor, you also need to think through quite strategically, why is it that you're investing? There must be a clear purpose and an end result that you want to see. I'm sure that you're not investing for the sake of just buying another property and pooling it into your portfolio. There's got to be an end result that you want to see as a part of your investment strategy. And I guess the other common mistakes is not considering protecting their assets. No longer have you only got your home loan or home at the moment, you now have an investment property. So having the wrong structure could have repercussions, and also not considering the protecting your loan or taking out loan protection or risk insurance from some of those unforeseen circumstances that could take place in life. The purpose and the use of the funds is really the only difference between the loan for a property investor and a loan for an owner-occupier. Owner-occupiers, we know their loans are non-tax deductible, and typically, owners prefer to reduce this debt, whereas property investors' loans are tax deductible, and because they have tax benefits, typically we see those loans set up as interest only upon the instructions of the accountant. That's where the balance remains the same, for an ongoing period. Both owner-occupiers and property investors have the same choice of loan product these days, the same features, the same benefits. So there's no discrimination. If you are a property investor, you don't get any more than an owner-occupier, and vice versa. If you're an owner-occupier, you don't get greater benefits over and above a property investor. I don't see a preference for whether one property investor or an owner-occupier taking a fixed rate more so over the other. So doesn't seem to be a preference for variable rate loans over fixed rate loans by either owner-occupiers or property investors. That comes down to your personal objectives, your personal goals, your strategy going forward. I'd advise property investors to do their sums first. The numbers have got to stack up before they even consider going out there looking for a property. Then, take the time to release some equity to pay your deposit on that investment property, and allow enough timing for the equity to actually be released, because that could take a number of weeks to actually be set up and available to you as an investor. I've also seen some investors get a bit creative with the type of property that they want to invest in. Make sure that the bank is willing to accept it as security. As an example, there are some specialised properties where banks might be a little bit reluctant to take on as an asset, or they may be reluctant to lend over 80%. In some cases, they may even reduce the loan-to-value ratio below 80%, which means that as an investor, there's a lot more that you have to contribute out of your own pocket or from equity in other properties. So do the due diligence there. Take into consideration what the banks are saying about the security property as well, because if they're not prepared to take it on, then you should also take that as an advice that there could be some concerns about that particular property going forward. Don't forget, protect your assets. Do not allow them to be cross-collateralised by the bank unnecessarily, and I would prefer prefer not to see them crossed over or tied up. So avoid having that being proposed to you by a bank as the only option. Investigate it further if you've been advised that your assets must be cross-collateralised. And lastly, I'd say, look, seek professional advice.